Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo, not the video, for the day before the Fed. It's the 21st of March. It's 2023. But before we start talking the Fed, which will be the focus of tonight's video, let's look at Nike. Nike, a big retail name, just had its earnings. And we'll look at the expected move real quick. That expected move for at least Friday session is about $10 up or down, $9.80. That gives a 100% implied volatility. After hours, is Nike moving $10 up or down? No, it is not. It had a surge up to 132 and an immediate fall. Again, with earnings, you'll know a little more than I do as I do the videos after the close. So you'll have this later and, of course, before the market opens on Wednesday. So that'll be the first thing to talk about, which is Nike. $10 expected move up or down. That puts it, roughly speaking, 135 or down here to 115. At the moment, it is slightly unchanged. And you'll just follow those numbers and follow the volatility on Nike and what that says about the broader retail sector. Now back to the Fed. Tomorrow will be the Fed day, and it could be a surprise. We've had the odds of a rate hike for a 50 basis point hike fall, rise, fall, and where we are now. The probability of a 50 basis point rate hike for tomorrow's session completely off the table, will not be happening. But what will happen? We'll update the Fed Watch tool just quickly. And this, to be clear about what we're looking at, is the Fed funds probability, or at least the current meeting target rate, CME group here. That's your interest rate Fed Watch tool. Well, what this is and how to interpret this if you're new to looking at this chart. The current target rate is right here, 4.5 to 4.75. That's your Fed funds rate, 4.5%. The odds of the rate increasing to 4.75, which is a 25 basis point or 0.25 quarter point hike, that's 4.5 to 4.75, 25 up, is 86%. The odds of the Fed doing nothing, which is keeping the Fed funds rate the same, is around 13%. These are numbers we've been watching for the last few weeks here in TheoTrade. And as these have changed, the market has changed. What majorly has changed has been the financial crisis has snuck up upon the global financial structure much faster and had large repercussions. We've not fallen into the cliff. That's your centralized central banks or centralized regional banks. And the contagion did take some of those banks down, but not the entire system. Credit Suisse is another example of a bank that did not survive this 2023 early, call it a financial crisis. I'm sure they'll make up a better name for it, but the regional banks, or at least the early 2023 financial crisis. And that's what we have dealt with as traders for opportunity and risk, mainly in the financial sector. Right here is XLF, took the hit, and a big hit just in terms of the broad financial community. That was a short or a fall, roughly 15% just in a few trading sessions. KRE is your regional bank stock or bank ETF. KRE in that same period, that's where the center of the crisis was, fell, and we're looking at the number here, 45 or so percent, over 40% of a rapid decline in KRE. Other bank stocks in the regional sector that were more affected, they fell further on the downside. So technology stocks were a gainer, at least in terms of capital flowing into technology stocks and away from financials. So the technology index is XLK, and that's going to look at large names. We'll look at some of them here in the NASDAQ. XLK is for the most part centered over in Microsoft, Apple, and these. The others, Amazon and Tesla, actually fall under XLY. And one of our biggest gainers in today's session was Tesla, up around 8%. The other was US Bancorp. So for the most part, car manufacturers, GM and Ford and Tesla all go in the same grouping. They were up in today's session, but outside of those, it was financial stocks that took the leadership in today's rally. So that is notable. Another beneficiary of the most recent flood to safety, or flight of capital to safety, has been the bond market. So TLT is a tradable ETF, and that is when the bond market or the financial crisis began, you saw money flow out of the banking stocks, out of regional banks. In some cases, traders or regular people, regular citizens, not just traders, but the average trader or the average person or the average startup took money out of their banks and put it into something more safe, be it CDs or bonds. And that alone has caused the Treasury bond price to surge. This week saw a little easing of that. And we see that off in the ZN 10-year Treasury note. That's a flight of safety to risk off, or protective assets being bonds. And the 30-year bond similarly saw its rally, as did gold. Gold was another beneficiary of money coming out of regional banks, or banks in general, and into the safety of hard assets being, in this example, commodities. One of those is gold. Bonds and gold were the beneficiary of money flowing out of our banking system in general. And that is an oversimplification, but that is enough to get the logic correct. So gold, on the big picture, simply traded back into the top or the upper resistance of its weekly trading resistance channel. That's just shy of 2,000 per ounce for gold. So even though it was on the back of a financial crisis and money flowing to safety, it's just in line with our broader picture of a trading range for gold. And money flowed out of crude and energy stocks in general on the deepening thought and real thought that this financial crisis has legs, it could spread. And not only that, but of course the interest rates going up, the Federal Reserve, and all the things going forward probably tips us into a recession. If not, that is just about guaranteed. And the plunge in crude was part of that data, or the data set, that suggested a recession. So flight to safety takes money out of the equity market. The Russell was the biggest decliner. It was exposed to financial stocks more than the NASDAQ. And the NASDAQ was a net gainer of money. So all that being said, that's the backdrop with which we go into tomorrow's Federal Reserve announcement. It's not just will they raise rates. I always have cautious to say they will do something, but 86% chance is just about as high as we would like it to feel comfortable saying they will raise rates a quarter basis point. But again, 86 is not 100. And we have to be prepared as traders, especially intraday or short-term traders, with the possibility that they will not raise rates at all. And that would indeed suggest that they're seeing financial conditions worse than what the data, or at least worse than what the public, we see. And if they keep rates unchanged, that could be a wild card. The initial thought, my thought, is that they'll send stocks, if that occurs, to the upside. But then again, almost like a hangover, the initial good news, hey, they didn't raise rates. That's a good thing for equities. If they didn't raise rates because they see bad economic conditions and they have to get in front of that, that's going to be a little concerning. So we could see an initial rally and then the market fall and fall further to the downside. That is if they choose not to raise rates, and what Chair Powell says in his conference after the decision. But the most likely scenario, and what the market is expecting and therefore pricing in, is that the rate will go up, not by 50, but by 25 basis points. And we'll see the typical Fed day reaction, which is, if that's the case, maybe a little surge of buying on the announcement, a little pullback, potentially a push up into the close. We'll be watching all these things carefully, but it does come down to what the Federal Reserve Chairman says in his meeting, or after the press conference, after the announcement in the press conference. And all those things will be playing throughout the big picture of bonds, yield, and looking at yield through TNX, Treasury Note Yield. That's the 10-year Treasury Note Yield. Can also take a look at TYX and other. That is your 30-year Treasury Yield, which still has an uptrend. But that will be in focus if the Fed raises rates. That would be additional pressure to the upside, potential pressure to the downside in bonds. And we'll see the effect on the equity market as it continues to play out going forward. Will this be it? If they raise rates and then say, that's it, no more rate hikes, that could be bullish for the market. We'll continue watching this day by day, step by step, moment by moment, and not getting too far ahead of ourselves with all the different headlines, risk, and of course, opportunities playing in the future. And one quick note before we conclude our video. In tomorrow's session, just looking at the S&P futures, it's pricing in roughly a $74 up or down expected move. But for the NASDAQ, it is pricing in roughly a $211 or handle expected move, and that includes the Fed. We'll be watching that throughout the trading session and, of course, throughout the announcement and the hours before the closing bell. Be careful and be safe. This is Corey Rosenblum with tonight's Theo video update for March 21st, 2023.